The S&P 500 has been an excellent investment for passive investors over the past few decades. However, the future is uncertain and we don't know if one economy is still going to be the top dog in years to come. So therefore, as a passive retail investor, you might want to look into a world fund to further diversify your portfolio and ensure that you're getting the best returns the world has to offer. So in this video, I'm going to look at the most popular Trading 212 world index funds to help you decide which is the best index fund for you. Now, if you would like to sign up to Trading 212 and receive a free share, use the link in the description down below. Alternatively, if you've signed up recently and haven't received a free share, use my promo code JUBAIR and you should receive a free share. So this is my Trading 212 invest account. Now, what you're going to want to do is to click on the magnifying glass here. Now here you can discover new ETFs, for example, going into the most popular ETFs, but as you'll see, the most popular ETFs usually are not just world index funds. They are a mixture of something like the S&P 500 and then a few other popular ETFs. For this reason, in this video, we're going to go to the search bar and type in world. Now you can see that when you do type in world, you do get the most popular global ETFs, and of course Vanguard and iShares are always at the top of most lists when it comes to ETFs. This is because both Vanguard and iShares have a lot of assets under management, and this is going to be a key metric that we're going to use as an indicator, although not 100% foolproof, as to how reliable this fund will be going forward. The assumption here is that if an index has a lot of assets under management, then a lot more people will have their money under a certain fund, meaning there will be a lot of vested interest within a lot of people, group of investors, to keep this fund going, although it doesn't always work like that. And the underlying assets of any sort of index fund is the most important thing to look at. So the first one is a very popular one, and this is the Vanguard FTSE All World, and this is the accumulating version. Whenever you see ACC, this means accumulating. Now let's go into it. We can see that this fund has the ticker code VWRP. As you can see, this is also an ETF on Trading 212. Now we are going to use this ticker code later on to actually find out more about the fund, because unfortunately Trading 212 doesn't have all the important information points. But in any case, we can see that this fund is designated in pounds, so as a UK investor there will not be any foreign exchange fees, and this is the one that you should go for if you want the Vanguard FTSE All World ETF. Of course, like I said before, this is the accumulating version, which means that any dividends that are paid out when this fund actually tracks the index is accumulated, so the dividends are reinvested automatically. You can see that this fund has been going up as the time has been going on. In the past year, this fund has actually returned investors 22%, which is actually very, very good and very similar to what the S&P 500 has given out. Of course, a bit lower than the S&P 500 returns, but we're going to see why this is, as this is a global fund, but most global funds will still have a huge weighting in the S&P 500 basically, or in other words, the United States of America. Now, like I said before, Trading 212 does not have all the information relevant for you to be making your choices. As always, my videos are not sponsored, so I'm free to use whatever platform I want to look into the ETFs. But one thing, when we stay on the Trading 212 app, we can go into instrument details and find out more about how the fund works. So when we click on this, there's another thing to note, is that here the ticker code is VWRP. The full name is the Vanguard FTSE All World UCITS ETF. Again, as a beginner, you don't really need to know what that means. It's just added there to be more complicated sounding so that you hire someone, pay fees, and they make money basically. The market name is the London Stock Exchange, which is important if you are a UK investor. You want to go for the London Stock Exchange. And then you can see the currency is in Great British Pounds. But anyway, let's download the key information document. So as you can see, this PDF is quite important. It tells you how the fund tracks the index. Like with any sort of ETF or index fund, what the fund manager is trying to do is to track a particular index, an index just being a benchmark. For example, the S&P 500 is a benchmark, so it's actually just an index, and this benchmark is in points. What the fund does is to try to allocate these points to real world companies. However, each fund differs because the fund manager ultimately will have total control of how it actually tracks the indexes that it says it tracks, if that makes sense. So at the top, we can see that the objectives and investment policy. So the fund employs a passive management strategy. So what passive management is that basically everything is handled with computers and algorithms. instead of actually hiring out people to take care of the fund. So that's active fund management. Usually with active fund managers, you're going to have to pay them a full-time salary and bonuses. So the cost of this is reflected into the total expense ratio or the price of the ETF. So with passive, usually you see lower prices. So this index is comprised of large and mid-sized company stocks in the developing and emerging markets. So then that is why they can call it a world fund, because it has the developing markets such as North America, Europe and Japan, and then it has some emerging markets, for example, stuff that we're going to later on see in this video. So the fund does attempt to track the performance of the index by investing in a representative sample index that is made up of index constituent securities. That basically just means that this fund is picking and choosing what it wants to invest, but whatever they're picking and choosing is representative of each sector that they're wishing to follow with the index. The fund also may use derivatives in order to reduce risk. This is stuff that you don't really need to know as a beginner. However, something very important in this document here is, of course, the ongoing charges, so the OCF, or in other words, the total expense ratio. So for this fund, it is 0.22%. And as many of you will know, you can actually create your fund by yourself on many of these newer platforms with a combined total expense ratio that is lower than this. However, for a lot of investors like myself, I just want one fund that I can have total exposure over the world instead of having to, rebalance multiple portfolios or multiple different funds. So it's just nice that everything is rebalanced on its own. So if I go onto the website called Just ETF, again, I'm not sponsored, I have no affiliation with these, but if I go into the search bar and type in VWRP and then press search, you can see that here is an index, and this is the one that we're going to find out more about, the VWRP. So this website is really good at finding more about ETFs. So here we can see this is the Vanguard FTSE All World UCITS ETF. So this is the one that we're talking about. You can see that the total expense ratio is 0.22%. So this is the right one, and it is accumulating like I've said before. So the reason why I want to use this website is to show how the fund actually invests your money. So if we go under holdings, we can see that these are the top 10 holdings. So you can see that the top 10 holdings are actually very similar to the top 10 in the S&P 500. For example, Microsoft, Amazon, Nvidia, Apple. So all the Magnificent Seven are still here, and you would be forgiven in thinking that this is just another S&P 500 fund. However, if we scroll down, this is the most important part. This is how the distribution of your money goes into different countries. You can see that 58.21% is in the United States of America. Now, compared to other world funds, which we will see, this is one of the funds that has a much lower weighting in the United States of America, which could mean in the short term, you're going to get less returns because the S&P 500 might outperform all the other indexes in that time period. However, in the future, you're getting a lot more of the rest of the world with this fund. For example, 6% in Japan, which is an economy that is very far away from the United States economy. Things happen very differently. Therefore, you're getting a lot more diversification from investing in two different countries, in two very separate economies. You also get 3% in the United Kingdom. And from history, we know that at one point, the UK was a superpower, contributing to a huge amount of the world's GDP. However, the great thing about investing in such index funds is, of course, that things can change around. So when economies actually falter and they go down the rungs, then the weighting towards those countries can also decrease going forward. Even though this is a passive fund, things can change. There are some decisions that need to be made, and that is also reflected in the total expense ratio. Now, if you want to find out more about the ongoing charge fees, the OCF or the total expense ratio, check out this video here, which explains everything in 4 minutes about how these fees are taken out. Now, if we scroll down, we also see with Switzerland, they have 2.45%, the Swiss economy being a very strong one in Europe. We have 2.4% in China, which in my opinion could be quite a bit because of course China is the second biggest economy in the whole world. But again, it is up to the mercy of the fund manager to decide where your money goes ultimately. But then again, countries like China, which aren't completely developed economies, do carry a higher bit of risk too. We can also see France 2.32%, former economies that used to be massive around the world, Canada 2.2%, Germany 1.98%, and India 1.93%. India being a very significant emerging market, and if not one of the biggest populations in the entire world, is going to be a significant contributor to the world's economy going forward. Now, in terms of sectors, 24.6% is in technology, of course, because it is quite still heavily focused on the S&P 500. And remember, these companies, especially the top 10, a lot of the Magnificent Seven, are valued so high that they put such a huge weighting on the global index. Now, 14.16% in financials, so a lot of financial companies there, a lot of also consumer discretionary companies, healthcare companies 10%, industrials 10%, telecommunications 7%, and you can see the rest, consumer staples, energy, basic materials, and other. You can also, with just ETF, see the performance of the funds. However, you can see this on Trading 212 anyway. But of course, if you want to learn more about these ETFs, just use this website. Again, I'm not an affiliate member or anything like that. So the next fund we are going to be looking at is by Vanguard once again, and this is called the Vanguard FTSE All World High Dividend Yield. And this is a distributing fund, of course, which means that dividends are paid out as cash to the shareholders. Now, this fund has a ticker code VHYL, and as you can see here, it is designated in pounds, great for UK investors. Now, over the past year, this fund has returned investors 12.24%, which is a whole lot less than what we've just seen before. Now, the premise of this fund, being a high dividend yield fund, is to invest in global companies that pay out a high dividend yield. Therefore, the returns that we see on this graph are not fully representative of what the investors have received. Now, let's go into instrument details again. You can see that this is also London Stock Exchange and Great British Pounds. You can see that this fund is also a passive management fund, which tries to track the performance of the FTSE All World High Dividend Yield Index. So their index again comprises of large and mid-sized companies. These don't include real estate trusts, and they include both the emerging and developed markets. Now, this fund attempts to track the performance of the index by investing in a representative sample again, and it aims to do this by remaining fully invested into the index. It might also hold a small amount of cash, but this is very small compared to the holdings. Again, it might use derivatives. The base currency, of course, is USD. However, this fund is given in Great British Pounds. There might be some sort of foreign exchange happening, but you're not going to really see that. You can see that the total expense ratio is 0.29%, again higher than the fund that we've seen before. But of course, it is up to the fund manager to decide how much something costs. And when you track an index with very specific stocks, such as high yielding stocks, it does cost a bit more to take care of that. So we're going to type in VHYL in just ETF and then go into the first fund. And as you can see here, the total expense ratio is 0.29%, and this is a distributing fund once again, and this is of course a distributing fund. Now, if we go into the top 10 holdings, we can see that it is very different from the previous fund. The top company here is JP Morgan Chase & Co, and the rest of the companies here, a lot of these you will see in the S&P 500. However, these aren't by any means the top companies. These are handpicked because they pay a certain threshold of dividends. So in terms of countries, this is still a world fund or a global index. You can see that 42% is in the United States of America. You can see that in Japan, there is 8.66% weighting, which is higher again than the previous fund. The United Kingdom, which is known for a lot of high-paying dividend companies, 6.81%, Switzerland 4%, and then the rest you can see so on and so forth. Now, in terms of sectors, 25% is in financials, consumer staples over 10%, and then the rest you can see here, industrials, healthcare, energy, technologies, so on and so forth. Now here from the basics, you can see that the fund currency is in the United States dollar and the currency is unhedged. So there are some funds that have hedging between, let's say, two currencies such as the United States dollar and the Great British Pounds, which means that if there are any fluctuations between them, there is some sort of a buffer and that effect is reduced to the shareholders. Now, in terms of dividends, this is where the fund VHYL differs. Now, the VWRP that we've just seen does not have a dividend yield because it doesn't pay out dividends. However, there is a version that we're going to go through next that does pay out dividends, and you will see that the dividend yield is a whole lot less than this one here. Now, the VHYL is basically aimed to give investors a high dividend yield from a global index. You can see that the current dividend yield is 3.02%. This is always tied to the price of the index, so that can can change at a moment's notice, but 3% is a lot higher than the S&P 500, which hovers around 1.1 to 1.4%. However, as we've seen before, chasing dividends is not always the best thing, because we'll see that sometimes what happens is that the growth of the company suffers when you are just focusing on companies that pay out dividends. So the next company we're going to be looking at is very similar to the VWRP. The difference here is that this is the distributing fund. We can see here this is the Vanguard FTSE All World. If we go into it, we can see that this fund has the ticker code VWRL. And over the past year, this has returned investors 19.89%, which is lower than what the VWRP gave. However, this is exactly the same fund, but this pays dividends on top. So the return is pretty much the same if you automatically reinvest the dividends, although not exactly, because the time that you reinvest your dividends is going to be a different time to when the fund automatically reinvests the dividends. Now, if we go back to just ETF, we can see that this fund is exactly the same as the VWRP, same total expense ratio, same everything. The only difference here is that it pays dividends. You can see that the current dividend yield is 1.53%, which is around half of what we've just seen with the Vanguard High Dividend Yield World ETF. But as we've seen from the returns, you're probably better off as a long-term investor sticking with something like this, because you're going to get some dividends, but also quite a lot of capital appreciation growth as the economies develop year on year. Again, this is not financial advice. I'm just showing you what your options are. Now, the next fund here is also Vanguard, but we're going to quickly fly through this because I don't recommend this personally. This is only because this is designated in euros and my channel is focused on UK investors. So yeah, if you are a European-based investor, this will pretty much be very similar to the VWRP. One thing to note is that this has a higher 1-year return compared to the VWRP, and this is more because of the differences between the pound and the dollar and all the different currencies used throughout the world. Because the euro is a completely different currency from the pound, the currency exchange differences means that you are getting 2% extra this year. However, in the future, in the long term, this difference is going to be pretty much negated. It's pretty much going to be very similar because there's always fluctuations up and down. Maybe 1 year, yes, you'll get more. The other year is going to balance out. So I wouldn't really worry about the currency differences there. Or in actual fact, think about getting a hedged version of an ETF, because I think in the long term, the currency fluctuations are not going to be too bad. Now, the next fund is from iShares, and we can see this is called the iShares MSCI World Small Cap, and this is an accumulating fund. Now, the good thing with Trading 212 is that for some reason iShare funds have all the information that we require, so we're not going to have to go to just ETF for this. But in any case, we can see that this has the ticker code WLDS, and it is designated in pounds here. Over the past year, this fund has returned 15.41%, which on its own sounds really good, but compared to the S&P 500 and something like the VWRP or VWRL, this is a whole lot less. We can learn more about the fund here, and this fund seeks to track the performance of small cap companies across developed markets globally. So with the other funds that we've seen, these are large and mid-sized capitalization companies. This one only tracks small cap companies, which have the potential to do a lot more growth in the upwards direction, but also a lot more volatility in the downwards direction, potentially. So with all these Vanguard funds that we've talked about before, their assets under management are incredibly high, and I didn't mention them specifically, but going forward with these lesser known indexes, I think speaking about assets under management is very important. So with the WLDS, you can see that the assets under management is only 2.65 billion, so it's actually relatively very small. The other telltale sign, try saying that quickly, that it's a new or very small fund is the fact that it costs a very small amount of money. As funds develop, they reaccumulate, the fund becomes more and more expensive. That's why sometimes you'll see funds that cost £1,000 per share. However, this is just a rule of thumb, but usually when the price is lower, it just means it has been tracking the index for a smaller amount of time. Now, the expense ratio of this is also very high at 0.35%, which is actually getting very high, and we really need to find out why. The main reason would be that you're tracking small cap companies, which a lot of funds don't seem to do, so it's a very niche ETF. You can see that the top 10 holdings One is actually in US dollars cash, Flex, Rexford Industrial Realty, and a lot of companies that you may never have heard of. So if we go into sectors here, we can see that 20%-ish is around industrials, 15%-ish is financials, consumer discretionary 13%, technology 11%, healthcare, real estate, materials, energy, as you can see, so on and so forth. However, the most important bit to understand is regions, and this is 60% within the United States of America, 11% in Japan, 5% in the United Kingdom, 3.59% in Canada, Australia 3%, and you can see so on and so forth. You can see that in total, this has 3,385 holdings, so a very, very high amount of holdings globally. Going back here, you can see that pretty much most of these holdings are in economies that are already developed. I wish I could find out what the other economies here are. In fact, let's just visit Just ETF to see if they know. So as you can see, Just ETF is coming up with a list here, and it doesn't really show what the other countries are. But again, there is some contradiction information here. United States at 56%, which is a bit different from the 60% that we're seeing from the iShares information on Trading 212. But in either case, this isn't going to be containing any emerging markets. As we can see, these are only on developed markets globally. Now, the next fund we're going to be looking at is the iShares Core MSCI World Accumulating Fund. This has the ticker code EUNL, and as you can see, this is designated in euros, so we're just going to quickly go through it. This has an expense ratio of 0.2%, which is actually not too expensive. Assets under management around 60 billion euros. And again, from the information, we can see that this seeks to track the performance of an index composed of companies from only developed countries. Quickly, if we go into regions, we can see is 69% in the United States of America, 6% in Japan, so on and so forth, as you can see here. Now, if we go into top 10 holdings, we can see again, very similar to what the top 10 holdings are in the S&P 500, because of course, this is around 70% in the S&P 500. Now, of course, I'm not going to recommend this for UK investors as it's in euros, so there's going to be a foreign exchange fee of 0.15% on top of that when you're using Trading 212, and a lot more if you're using other platforms. So the next fund we're going to be looking at is by Invesco, so not by Vanguard or iShares, and this is the Invesco FTSE All World ETF. Now, first of all, you can see that this has the ticker code VWRG, and you can also see that this is designated in pence, so this is pence sterling for some reason. I don't completely understand why companies do pence, but I guess there's more granularity when doing pence, and this adds up to around £5.3, which again is quite a small fund. This also hints that, you know, this is a new fund, and you can see over the past year this has returned investors 19.4%, which is looking pretty good. Now, unfortunately, Trading 212 also doesn't have any information on Invesco funds, so we're going to have to use Just ETF again. So then we use the ticker code FWRG. Now, here is the FWRG, and first of all, you can see that the total expense ratio is only 0.15%, which is the cheapest that we've seen so far. So from the description, we can see that this fund seeks to track the FTSE All World Index, and it does so by investing in developed and emerging countries worldwide. Now, you can see that the fund size is very, very small at only £170 million. However, the total expense ratio is very small, so I'm guessing this is a new fund that is slowly trying to catch on. And as you can see, very, very new fund created on the 26th of June 2023, so not even a year yet. And here are the top 10 companies. These are Microsoft, Apple, Nvidia, so on and so forth, which means it has a huge weighting in the United States of America. Now, here you can see for confirmation that we have 60%-ish in the United States of America, 6% in Japan, 3% in the United Kingdom, France 2%, Switzerland, so on and so forth. Now, I would love to know what sort of emerging markets they have here. The only emerging market that is considered an emerging market kind of is China, although they are the second biggest economy in the world. I'm guessing India and other countries such as Africa are probably here, but I would love to know what that is. Unfortunately, we can't find out here. But in terms of sectors, 25% technology, 13% financials, consumer discretionary, and more, you can check out for yourself very easily here. Now, you can see this is also available in other currencies. For example, GBX is the one we've seen here, which was in penny sterling. You can also get it in United States dollar and in other currencies such as the euro. I think this is the Swiss francs here. But you can see each one will have a different ticker code because different ticker codes mean different things, even if they're slightly changed. Now, of course, this is an accumulating fund, so the dividend yield is not presented as a figure. So the next fund we're going to be talking about is from Xtrackers, which is another company maybe you've never heard of, but of course not as big as Vanguard or iShares. So let's go into this. This is the Xtrackers MSCI World Accumulating Fund. And as you can see, this has the ticker code XDWD, and this is designated in dollars. And you can see this is $109.35 currently. Over the past year, doing really well, giving us a return of 23.57%. Now, I would love to know more about this fund, so let's just go back to just ETF. So first of all, this has a total expense ratio of 0.19%, which is not too bad for a world fund. But let's find out what this fund does. So this fund seeks to track the MSCI World Index, and it does so by tracking stocks from 23 just developed countries. Now, if we go here, we can see that the fund size is 9.4 billion, which is not that small. It was created back in 2014, so it has a few years under its belt. You can see from the top 10 holdings, again, it has to be very highly America focused because all the top companies are S&P 500 companies. So in terms of countries, I was right, 68% in the United States of America, which is really, really high. And then 6% in Japan, 3% in UK, and then you can see the rest of the companies here. Sectors, 26% technology, 12% financials, and so on and so forth here. So again, another world index which tracks the world developed countries with a huge weighting in the United States of America. At least there is a lot of choice when it comes down to investing over world ETFs, but they basically pretty much have the same backbone. A whole swathe of it is in the United States of America, and then bigger economies such as Japan, UK, and things like that. Not really very personalized or experimental, but that just goes to show that people trust what is tried and tested. Now, next we're going to be looking at the iShares Core MSCI World Accumulating Fund, and this has the ticker code SWDA, and as you can see, again, pence sterling, so that's around £7.87. Over the past month, doing really well with a return on investment of 23.44% positive. You can see that the total expense ratio is 0.2%, assets under management quite big at £50 billion. You can see from the top 10 holdings, again, a lot of weight in America. If we go into regions, we can confirm that 70%-ish is in United States of America, 6% in Japan, and here we can see the rest. Again, this is another world index that composes of companies only in developed economies. I personally would rather, if I had just one fund to invest in, have both emerging markets and developed world in the same fund. However, of course, with Trading 212 or any other investment platform that I talk about, you can create your own world fund by getting a developed one and an emerging markets on top of that. And as you can see when I scroll down, there are also a lot more different world funds that I'm not going to go through this video that have different themes. For example, you can get iShares MSCI World ESG Enhanced, so targeting ESG companies. You can also see this fund here, which is the iShares World Value Factor Accumulating Fund. You can see this is in dollars. However, over the past year, it is up by 20%. Total expense ratio 0.3%. Assets under management about $4 billion. You can see the top 10 companies are not like the S&P 500. This is because this fund seeks to track the performance of an index that is composed of a subset of the MSCI World stocks. So these capture undervalued stocks relative to their fundamentals. So this ETF looks at certain factors. In this case, specifically looking at value factors. So it tries to invest in companies that it thinks is good value, looking at their fundamentals. So doing a lot of digging under their balance sheets and stuff like that. You can see in terms of regions, this has a very, very low weighting in the United States comparatively. So this has only 38%, the lowest we've seen today. Japan is the highest we've seen today at 23%, but you can also see the UK is also very high at nearly 10%, France, Germany, so on and so forth. Again, these look all to me like developed countries, so I don't think there are any emerging markets here, but you do get a lot of the big players when it comes to the whole global index scene. Again, like I always say, this is not financial advice. Do your own decisions. Just because something is going up based on certain factors does not mean that past performance is any indication of any future performance that you may ever get. Again, you can see one from Xtrackers, which is the MSCI World Quality Accumulating Fund. This again is in pence sterling, and over the past year, they have received 27.23%. So the Xtrackers fund has a total expense ratio of 0.25%, which is not too bad. had. This is 68% in the United States of America, and the rest you can see here. But what this fund tries to do is to track the MSCI World Sector Neutral Quality Index from 23 developed countries. You can find out more about this fund over here, but I think over the past year it has done incredibly well, pretty much matching the S&P 500, even though this is technically a global fund. And of course, I can go on forever and ever. There are other fund providers like Invesco here, iShares here, and even BlackRock on their own. If you didn't know, iShares is owned by BlackRock, which is one of the biggest fund managers in the entire world. But you can go on and on. You can even see HSBCs here, other companies here. This video is just going to be too long if I just went in. If you want more videos like this, always comment down below, and I'm always up for new ideas. So make sure to check out some of my other videos, and I will see you in the next video.